2.5% projection still intact, given concerns about rising oil prices, for instance?
Yes, so we have recently revised our India's real GDP growth for FY22 at 9.5%. But this revision was largely on account of better than expected recovery in the September quarter. So the UBS India lead indicator, which is known as an activity tracker, it basically recovered by 16.8% on a sequential basis, which is quarter on quarter, on progressive reopening of the economy post the second wave, after contracting 11% quarter on quarter in the June quarter. So I would say, yes, the recent supply side disruption, including high global commodity prices, especially oil, and the domestic coal shortages, could weigh on India's fragile economic recovery. But at the moment, we are pretty comfortable with a 9.5% real GDP growth forecast.
So what's the threshold for oil prices before India's GDP gets hit?
Okay, so if you look at what is happening on the global oil prices, they're almost up 30% from the August lows and are near, 3-year high. Now, India is a net oil importer. I would say we import 84% of our oil requirements. So any sustained rise in global crude oil prices is a negative shock to the economy. So we can see a wider deficit, a high inflation, and a weaker currency. But I guess at this point in time, when we are seeing higher oil prices, the one thing which I would be incorporating is what happens to India's external position. And the sensitivity is that every $10 a barrel average increase in a global crude oil price widens India's current account deficit by 0.5% of GDP. So I would say if oil prices are headed towards $100 a barrel, which is not our base case, the current account deficit in India could actually widen to 3% of GDP. And in such a scenario, there's a risk that INR could on a temporarily basis test 78 against the dollar. But again, in our base case at UBS, we are still estimating Brent at $67 a barrel by end March 2022. And we will say, unlike 2013 and 2018.
Yeah, I was going to check.
I think when it comes
to this consumption boom that we've been talking about with Reliance, with ICICI Bank, we're seeing that retail is coming back in a very big way. You could say it's kind of a revenge spending, so to speak. How long lasting can that be, given just the inflation risk out there?
I would say it could be a next 2-quarter story. That is the December and the March quarter story. So what we are seeing is that there is a pent-up demand, especially as more people are getting vaccinated. And this is getting visible in both the goods and the services consumption. So top 20% of India's population accounts for almost 60% share in discretionary consumption. And what we are seeing is that as people are getting vaccinated, the forced or the precautionary savings, which we saw during the pandemic period, is now begin to getting spent. In fact, we recently did a UBS Evidence Lab survey where we, surveyed 1,500 Indian consumers. And it basically indicated the same trend that the affluent Indians who received income continuity during the pandemic period could support the ongoing festive season demand. So I would say next 3 to 6 months, the pent-up demand story is definitely going to sustain.
Right. And you take a look at indicators like luxury car sales, for example, and you're seeing that this recovery is being driven by the rich. At what point then, Tanvi, are we going to see more of a broad-based recovery?
Okay. So for a broad-based recovery, right now I would say bulk of the recovery is led by consumption. The second is public capex, because there's a lot of effort being pushed by the government on boosting capex. And the third is exports. So the goods exports are almost 25% above the pre-pandemic period. So the key question is, as India moves towards 2022, what is going to drive India's growth story as this pent-up demand kind of fizzles out, maybe because of inflation, because of forced savings being spent. In that sense, I think the key question is whether India can again see some kind of capex-led recovery. We are not expecting any private corporate capex to turn around anytime soon. So the recovery either has to be met by the public capex that is the government really pushing on infrastructure and the capex spend, or led by the residential real estate recovery, because we are seeing the tailwinds of mortgage rate, close to a decade low, which could be supportive of some recovery in the residential real estate market.
And it brings the question then, we heard from the finance minister speaking to Bloomberg recently saying that there's not really a hurry to withdraw the pandemic-driven stimulus. You also have an RBI that seems to be more leaning towards maybe easing. I'm just wondering, how long do you think fiscally and monetary policy can stay accommodative?
Okay, so I would say on the monetary and the fiscal policy, right now they are both moving in line to support this fragile economic recovery, because India, even if we saw a V-shaped recovery post the second wave, the economic recovery is not very strong. As we just discussed, it's not broad-based, led by a couple of sectors. And we have seen the unorganized and the informal economy taking, bulk of the breath during the pandemic, which is yet not reflected in the reported GDP numbers. So we are estimating RBI to begin the process of policy normalization, that is moving to a neutral stance or a reverse repo rate hike, likely in the first quarter of next year. So beginning the Fed policy is when we are estimating the first step towards policy normalization to begin. From the government's policy perspective, the fiscal policy, if you look at, we are estimating the deficit to consolidate this year, not because the government is doing any expenditure cuts, more because the revenue collections have been quite buoyant. So I would say the fiscal and the monetary policy consolidation is something you should start to see beginning from early next year.